All right. Guten Morgen. Yeah, welcome to Forex.Today. Yeah, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. So, guten Morgen. It's Friday. Need that coffee. Holy smokes. What an amazing week. Actually, amazing 2 or 3 weeks. Maybe we got some breakouts today, but it seems like there's been a lot of sideways action combined with a lot of volatility. Holy smokes. So I hope you're thriving and surviving and learning and I don't know. Look at that. A haircut needs to be put on the agenda. But anyways, good to see ya. My name is Wayne. I'm a currency trader. Before this, I worked as a venture capitalist. Before that, a high-tech entrepreneur. And coach to high-tech startup CEOs. Yeah, even the government of South Korea once hired me for, I guess I was in South Korea for about a week or two. Kind of interesting. Yeah. Interesting past life. I even worked at NASA. Can you believe that? I had to go through security. There was always a guy standing there with some sort of automatic weapon, and he had to check my ID every time I went on into Moffett Field. Anybody know Moffett Field? Back in those days, a P-3 Orion would land every, 10 minutes or 8 minutes or something like that. Yeah, so working on a NASA base, a military base, was, pretty cool. Why would I be doing something like that? Well, I was I worked in the research department on heads-up displays, so I flew virtual reality simulators in 1991, I guess it was, before there was virtual reality. Cool. Well, why was I doing that? I wanted to be an astronaut. An astronaut. Hey, kids, before SpaceX. Yeah. Well, it turns out I'm a diabetic. You can't go to space if you're diabetic. So anyway, so that's that. So anyways, long journey, and I've learned a few things along the path, just like you. We learn from positive and negative experiences in our lives, and then we bring all that baggage, good or bad, with us to this thing we call Forex. So I'm a businessman. I'm an entrepreneur and investor. So I have always looked at Forex like a small business, like a startup. Why? Dude, I worked in the Silicon Valley as a high-tech startup, as a coach to high-tech startup CEOs, and as an investor into high-tech startups. So look, that's how I look at it. Forex is a business. So I'm going to look at things where, I'm going to look at trading in such a way that I believe you need planning. You need strategy. You need tactics. Okay. So there should be a process and a plan in place, not just randomness. So that's how I look at it. And if you agree with me, then you're in the right place. So ask questions, get involved. I'll bring my good and bad with me. You'll bring your good and bad with you. And we'll make sweet trades together. Nice. In the description below the video, you will see a link to my book, Strategic and Tactical Forex Trading, my community, fxbootcamp.com, my macroeconomic tool, QuantBox. There's a link to Tradersway.com. I don't own it. Someone said that the other day, like, oh, I don't own Traders Way. But anyways, they are a trustworthy, ethical foreign exchange broker, and I do recommend them. So all those links are in the description below. But remember, those resources were made for you. In fact, I created or accessed these resources because members of the FX Bootcamp community and the Forex community in general have asked for it. And that's why they're there. So check out all those links. And while you're doing it, hey, click the thumbs up button, huh? So I'm watching Euro Pound right now. I'm kind of interested in this over the next 90 minutes. This is just leftover from the swing trading group last night. But let's zip over here. Let's clean our slates. Oh wait, this is the big one. I don't want the big one. I want the itty bitty. I don't want the big one. I want the itty bitty. All right, so overnight we have some dollar strength. Ooh la la. Okay. We have yen strength. Ooh la la. Swiss franc strength. Ooh la la. Aussie and Kiwi coming down, and euro. Risk off. Risk off, Bubba. So let's take a look at what you're doing. You're taking the euro down. Okay, you're taking the euro down, so we can take a look at that. I guess we'll do it this way. Okay, and you should be taking profit soon. Yep. Okay. So for risk-off traders, okay, we had a top here 3 weeks ago, 4 weeks ago. Then we had another top here. And remember, we already knew that that was the out zone. Then we had yet another top, so we had a triple top. So this week, your trade plan may have been, or likely was, this. And even though you have euro dollar moving red hot today, it's probably one of the biggest losers. It's probably, well, how do you say it with song? This is the end. I'll never trade Euro USD again. Yeah, that you know, look, if you're using these tools, the tool says there's a high probability of, once this gets down below 109, in fact, it's 108.67. So you could say as low as 108.5. That's based on statistical analysis of last week's range. That's a lot to hope for and get. And if you expect more than that today, well, that may be illogical. It might actually happen, but it may be irrational thinking versus, right, logical. You know what I'm talking about? So what you might find by EOD, end of day, is you might find like an upseat and get that next week. What do you stink? Smells good to me. Awesome. Okay, Coolio. Coolio. I guess we can take a look at this one. Let me ask you something. Are we using the correct tools? to try to accurately understand what's happening in the market. Well, imagine that euro dollar is doing the opposite. It's hitting its take profit zone. We don't know what's going to happen in the future, but Kiwi dollar hit this a couple of days ago. It hit its profit taking zone. What happened? We have the right tools, don't we? Oh my goodness. There was a time in your career where you would be blindsided by something like that, right? What does that red zone, for those that are not familiar with the teachings, it is the way, the teachings of FX Bootcamp. That pink zone above us for bulls, so look, we were in a bullish trend, right? You can see that. This green zone means buy, this green zone means buy, and then you get to this pink zone. It doesn't necessarily mean sell, but it means stop buying, exit. Now, you can take that further. Once you get the lower low, lower high, at this point, you can then start selling. Okay? So the first circle is all about the exit. My exits are so profit, right? And then this one is entry. Okay. Okay. Alan says, Nikkei shows no signs of risk off. Well, you have a central bank purposely keeping money cheap. So that's stimulus for the stock market. Okay. Okay, you got it? You get it? You got it? You know it's good? Nice, right? Now you might say, well, what's the target? And that's the interesting part of this whole process. It's not, there isn't really a target. This isn't actually the trade. This is more of an exit of a trend. Okay, so one way to really be looking at this is there's just different variations of this. Lewis says, should gold be higher? No. You haven't been listening, Lewis. I've been talking about it for weeks now. Probably 3-4 weeks. In the scenario of, let's say, stock market not up. Even if you're not predicting a crash in the stock market. You're not predicting the S&P 500 dropping down to its October low. But let's just say no longer higher. If you are in that camp, gold will fall. It's disinflationary. You don't need to hedge with gold if inflation's falling. You're like, why is it disinflationary? Well, your retirement account's going to lose money. The paper value, or if you actually try to sell your house, is going to lose value. Bitcoin's going to lose value. Okay. That's disinflationary. That's prices coming down. The only thing going up now, so I bailed on a whole bunch of positions in my retirement account at the top of the stock market, by the way. This was about 10 days ago, so nailed it. Ooh! Right? So, so what did I keep? I kept my investments into prisons and liquor stores, old folks' homes, and builders. Now, why would I keep builders? Why would I keep home builders? You have to thread a couple of pearls together to get the logic. One, people have locked in low mortgages back when interest rates were zero. So their mortgage, the average mortgage in the United States is about 3%. Mortgages are now 6%. Okay? People will never, ever, ever sell their house. They're in 30-year mortgages at 3%. Less than inflation. Whew. People are locked in for 30 years at 3%. When will interest rates fall so that a mortgage is less than 3%? It's never going to happen. And I told you 3 years ago. Get it while you can. Get as much of it as you can, because you'll never see it again. And that prophecy, the prophet of profit, has come true. So never, ever will somebody sell their house unless they have to. Because if they sell their house, then they got to buy a new house at a 6% mortgage. Well, nobody wants to do that because your monthly payment will double and you're probably not going to get a significantly better house. So forget it. Nobody ever is going to sell. So how does a renter move from renting to owning a house? Does anybody know? Now, they're going to have to get a mortgage, and they will have to pay 6% or 5%. Interest rates will come down eventually, right? Eventually. It could be 5 years from now. It could be 3 years from now. It could be next year. It could be this year. Eventually, interest rates will come down. But they'll buy a new home. Maida is absolutely, totally correct. So, this is what I said a year ago, and I'm going to repeat it again. Okay? Back then, a year ago, interest rates are going up, and the media said no one will ever buy a house. Oh, is that right? And the worst performing sector in the S&P 500, the worst performing, was home builders. In fact, the home builder stocks were so cheap that you could buy a home builder. Let's say you had $1 billion in cash, and you just decided to buy the entire company by buying all its shares for $1 billion. Okay, imagine this. You buy every share, you corner the market, you buy every share, and now you own 100% of the company. You now own the company. You paid $1 billion to own every share, but the company owns land valued at $1.25 billion. The company was worth less than its assets. The market, right? The market value, the value of all the shares, was less than the assets the company owned. And I explained this a year ago, so I bought it. And now I'm up 25%. Cool. That's not bragging, that's economics. I'm trying to do economics and behavioral finance, right? So you should be able to look at it. Now, the first stock I ever bought was Apple Computer. I paid $6 a share for Apple. And the number one reason I did it is because if you added up all the value of all the shares in the stock market, or let's say all the shares outstanding, the value was less than the amount of cash Apple had in the bank. You see? So imagine Apple on that day, it was a small company, it was worth $1 billion, but it had 1.5 billion in cash in the bank. And I'm like, dude, I could just buy every share and make $500 million. So I didn't buy every share, but I bought as much as I could. And I held it for 30 years. Yeah, I forget what it was, but because it split and split and split and split, so it was complicated. But I think I paid $6 a share and ended up selling them for like $6,000 a share. Yeah, it might have been actually bigger than that, but whatever. Good. The point is the book value versus market value, and being able to think forward, think ahead. So now those are like one of the best performing stocks. I bought the cheapest performing stock, and now it's the best performing stock because people realize no one will ever sell their house. So you're going to have to buy a new house. It's going to be a smaller house because your mortgage payment is double what everybody else is paying. Well, too bad for you. You should have bought when it was cheap. So now that you're buying when it's expensive, people this is how people shop. They don't shop by price. They shop by how much they can afford every month, right? So let's say you can afford a $5,000 a month mortgage. Okay? 3 years ago, that would get you $1 million house. Now it'll probably get you a $600,000 house. There you go. That's life. That's life. Okay. So anyways, cool way to look at certain stocks. The book value versus the market value. And you'll see that there's inefficiencies from time to time. Interest rates going up scared people out of real estate. But it's short-sighted thinking, isn't it? Anyways. Cool? It's a good lesson, right? So anyways, I kept that because it could be 30 years before we fix this market. Remember, this is all stuff the Fed created. Let me clean some of this up. The point is the Fed was wrong on inflation being transitory. I don't blame them for that. Then they were late to raise interest rates. And then when they decided to raise interest rates, they still were doing quantitative easing. Do you guys remember that? They were still doing QE. And I'm like, it doesn't even make sense. You're raising rates and pumping money into the market. Like, very, very strange, right? And then they're like, oh my God, we're way behind the curve. Now we got 10% inflation. So boom, then they raised interest rates so fast that now every bank in America has a portfolio that is losing money. Well, that's not good since imagine the regulators essentially through their policy forced banks into bankruptcy. So, yeah. But I'll remind you, there's only been 2 chairs of the Board of Governors, which is the Fed, that were not economists. Arthur Burns and Jay Powell. So they have that in common. They're not classically trained economists. The second thing they have in common is during their reign as governor of the Board of Governors and chairman of the FOMC, was that the economy had rampant inflation. Isn't that just amazing coincidence? I was listening to an interview on Bloomberg this morning, and someone was talking about banking deposits that changed around COVID, and he said banking deposits increased by $5 trillion. And I'm like, yeah, oh man, it was cool, because I'm like, that's the stimulus. That's the $5 trillion the U.S. government pumped into the market. Isn't that interesting? We were talking about that. Now, how come it doesn't include the Fed's $5 trillion? The Fed didn't pump money in the market. Remember, every time I get all pissy when people say the Fed printed money. No, the Treasury prints money, but the Treasury didn't print money. The government borrowed money. So it was more like a credit card, not the printing press. So the government borrowed money and then gave the money away for free, but they still have to pay for the money. So it's a negative investment. There's no productivity. There's no return on investment. So they just burned the money, but we still have debt. And now we're still debating whether we want to pay for the debt. Just negligence, isn't it? Isn't it negligence? What we have? You're like, dude, you borrowed $5 trillion, didn't invest it, but instead just gave it away for free. And now you want to debate whether we should pay for it. And you're like, but it's really expensive to pay for. Uh-huh. Okay. But anyways, the Fed creates credit. It doesn't create money per se. It creates credit. So anyways, so $5 trillion went into commercial banks. And so what did Bank of America and JP Morgan and Wells Fargo, what did they do with the money? Well, we had a zombie apocalypse. So there wasn't even demand for. People didn't want to borrow the money because they couldn't even go look at a house to see if they wanted to buy a house because we were locked down. And even then, people are like, oh my God, well, you got to wear a mask and you got to wear a bunny suit and you got to disinfect, right? People are like, I don't want to buy a house during all this crap. So banks didn't even have people asking for mortgages. So Ashish is right. They bought treasuries. What return on investment did the treasuries pay? So German, you don't understand. By the question you just asked, you don't understand the foreign exchange market. So I'm just going to say that. I'm not going to give you the answer because it doesn't matter. But there's a mismatch of what you're asking, which is a good question. But because you're asking it, there's a giant leap, a giant gap in the way. So I'll deal with that later, or dude, just join FX Bootcamp and go through the training courses. I cover it every which way but loose. Okay, so anyways, the banks had $5 trillion. There were no loans to give out because nobody needed a loan. We were in COVID lockdown. You were locked down. You're not going out to buy a house. You were locked down. So the banks then have to buy bonds, in this case, treasuries. The treasuries pay very, very, very little, but it's okay because they don't have to pay you really anything for your deposits. Remember, banks have to pay you interest now. So fast forward, the Fed jacks up interest rates, and now banks have a portfolio of treasuries that pay 1% or 2%. They have mortgages that pay 3%. And what happens? Well, the Fed jacked up interest rates, right, to 5%. So money markets are now paying 4.5%. So what do you do with your money in the bank? Because you look at it and the banks are only paying you 0.5%, maybe 1%. So you're like, you take your money out of the bank and put it into the money market. Because you're like, it's kind of like a bank anyways. Boom. You can get your 4.5% over there, right? What does the bank have to do to cover your deposit? Because you're making the decision. You don't want to keep it in the bank and earn 1%. So you're like, I'll put it in the money market. Okay. Wealth managers. So I have a wealth management team and they're like, yeah, we'll give you 4.5% on your cash. Oh, sweet. So I take it out of, let's say, Bank of America and I give it to that team and they're boom. Or you can do it directly. I know Goldman Sachs offers something like that where you can give the money to Goldman Sachs, just your cash. It's not even a CD, it's cash. And over 4%. But those are not banks. You see? You're giving, Goldman Sachs gives you a high yield account. It's not a bank account. It's a money market. Or your wealth management team says, give us your cash and we can pay you. And again, it's not a bank. It's a money market. Even stockbrokers, okay, right now will pay you, I won't say which one, but there are many now probably offer the same type of program. But all the cash that you haven't invested into stocks or treasuries, they will pay you over 4%. 4.5%, I think, is about the number right now on your idle cash ready to invest. So while you're waiting, while you're deciding what to do, they pay you 4.5%. So you take your money out of your bank, right? It makes sense, right? But what about, whoa. But the banks have invested all that money into treasuries. And the treasuries only pay 1%. No, we'll get there. We'll do oil. The treasuries they bought only pay 1%. A new treasury pays 3.5%. Older ones pay 4%. So the value of these treasuries that were bought 2 years ago have dropped by, let's say, 50%. So technically, these banks are insolvent. And it's the Fed. The Fed did it. The Fed did it. Amazing, right? See, if the Fed raised interest rates to 5%, but they did it over 3 years, what would happen is the treasuries, especially the shorter term ones, the 3 months, the 6 months, the 1 year, and the 2 year, over time, they mature and you roll over to the new one. And the banks have an opportunity to get out of their low-paying ones, which on paper have lost money, but in the real world, because they're not mark-to-market, haven't actually lost money. So they mature and you get 100% of your money back. And then you take that money and you buy a new 1-year treasury at the higher rate, and now you don't have the risk. Cool. Not a problem, right? Not a problem. So if the Fed raised interest rates, let's say 25 basis points a meeting for years, 2 or 3 years, that would be fine, which means they should have started raising interest rates earlier. And they probably should have stopped quantitative easing earlier. Okay? Or they stop raising interest rates at 3.5%. Remember, we all thought 3 3/4 was the number for a while. And instead of raising interest rates, they only did quantitative tightening. Okay. Now, Louis says, true, but some regional banks made bad investments. Well, tell me what the bad investments were. Give me an example. Because you might say, well, they gave some of their biggest and best quality clients with free mortgages, but then they had that money and then they were able to make money in the market. But you just said bonds. Well, they're not technically bonds, they're treasuries. But what I'm telling you is it's the only thing they're allowed to buy, and the only thing available at the time were low yield. What do you mean? No one was borrowing mortgages, so the only thing a bank could do is buy treasuries. But because the government was doing quantitative easing, those treasuries paid almost nothing. So is it truly a bad investment? It was the only thing they could do. And why were they poor returns on investment? Manipulation by the central bank. But is it the regional bank's fault? Now, of course, all this should be hedged, but realize they couldn't even afford to do the hedge anymore, because to keep the deposits, they might have had to do things like pay higher interest on deposits. And all of a sudden, like, they're earning 1% but paying 3%. Like, all of a sudden, these banks are losing money. And it's not because they were bad banks, is my point. Okay? And then it only makes sense that people move their money to the money market because banks were not paying the same interest level. Why? They were only earning 1% on let's say 1 or 2%. Let's say 2%. If a bank is earning 2% on their treasury portfolio, can they pay you 3% interest to keep you there? Well, dude, not only can they not do that, out of the 2% of their portfolio, they have to pay you 1% interest, but they also have to pay, with that last remaining 1%, they have to pay all their rent, they have to pay all their salaries, they have to pay their other expenses. You're like, dude, it's not a lot of money. And then suddenly money markets pop up because the Fed's jacking up interest rates. Now they're jacking them up to 5%. So now a client comes to the banker and says, if you don't raise my interest rate level on my deposits to 4%, I'm withdrawing the money. And they're like, dude, we're only making 2%. Just like full 100% revenue is based on 2%. We can't pay you 4% because we still have to pay salaries and rent and everything. They're like, yeah, screw you. And they withdraw the money. And now the bank is forced to sell all those assets at a loss because it's law. It's on demand, right? So there you go. Interesting, huh? Interesting. Yeah, okay, let's take a look at some commodities. By the way, I'd like to thank all the members of FX Bootcamp that attended last night's meeting. I had a lot of fun. You notice I kept it at 3 hours? Yay! Only 3 hours. But we have so much fun. I'm shocked. Okay. Okay. Meh, 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 meh. Meh, 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 meh. Okay. Looks like we're kicking off the M1. The potential here is counter trend trade. It's not quite there yet on the 1 hour, but it could be your plan of attack for next week. Yeah, right, Greg. Well, Greg, nobody listens to majestic silverbacks like us. They like to talk about 2008, and you're like, dude, what about 1978? There were lessons learned in 1978, 1988, 1998. Remember those years, right? Irrational exuberance. And Wall Street doesn't remember any of that. Right? Oh, yeah. No worries, Lucas. Yeah. Yeah. Crypto, you didn't like the part about the cake car? I only went on, what, 5 minutes about the cake car. Yeah. And Jim's like 1966. Yeah, for sure. Well, yeah, what happened when we went to war? Inflation. Yeah, for sure. Is that Greg, right, Gregers? What was it? So my first stock was Apple. My second one was Cisco Systems. Is that right, Crypto? Greg's like, it was AT&T. So anyways, so that's a bit early here, but maybe you drop into a fiver and you tactically take this on like scalping. So one of the things I did in the day trade or in the swing trading group last night is I did a coverage on scalping. I know it's swing trading, but look, you scalp into a swing trade, right? So anyways, your swing trade for next week for oil could be up if that's, I mean, you do you, man. And so you psychologically point this up. Now remember, the up is based on this. So your entry, if you are strategically planning your trades in advance, right, has to do with the higher high right here. That's an HH. So this, okay, this zone, I'll put it, let's do this in like hot pink. Yeah. So your buy zone is here, here, here after the HH. So changing colors one more time. On this 5-minute chart, based on the monthly pivots, which you knew 3 weeks ago. Up, 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 down, down, and you're long and gone. Scalping long, it might last an hour, but it might last 3 days. Oh, is that right, Greg? That's interesting. I think your sister probably did better, though, right? Or did somebody buy SeaWorld? I mean, as soon as Free Willy came out, you might as well just short sell SeaWorld, huh? So what do you think? You see how you thread these needles? Okay. If you were setting up a WTI counter trend, okay, then you are looking for at least short-term bullishness at long-term support. Therefore, you have this trapped. Then you wait for the higher high to confirm using price action. So here's the higher high relative to resistance, resistance, resistance. Cool. So you buy the dip, long and gone, easy peasy lemon squeezy, jam your stop, take a walk. Yeah, she kicked butt, I'm sure. Yeah. That is amazing. Yeah, so I know a lot of people that are wealth managers, and they all have stories of like, you know, some old woman dies, like grandma dies, or great grandma lives to be 100, and then she finally passes. And so the family comes in and they're like, okay, well, she's got these assets, and we've part of the estate, and it's got to be transferred to the heirs and all that. And they're like, wait, and they look at the account. So this old lady's nearly 100, but in like 1948, when they got married, her husband was gifted Coca-Cola stock. And they have this paper stock certificate. Like it's paper. And they're like, yeah, so what's the basis on that? Anyways. And you're like, oh God, really? Yeah. And there's, it's pretty funny sometimes. You're just like, or a railroad stock. And now you have to sometimes go back and you're like, well, the railroad stock was bought by another railroad in 1962. And then 1979, that one was bought by something else. And then there was government deregulation. So then that was resplit into a new company. And then 15 years after that, the deregulation failed. So then there was consolidation in the market. And then you're trying to figure out, like, where does this railroad live? Like, where this stock certificate? And you're like, I guess it's Union Pacific, right? And so somebody's got to do all this research. So anyways, it's kind of funny. All right. We go over here, and we're still on the up, but still not up. We're still on the up, but still not up. So the big sort of event, if you will, is if, and I think it's a probable, so it might be like when we breach. Now, I'm not going to give the answer because I discussed it in the swing trading group. So the swing traders and the day traders know, but I have a window of opportunity. So I discussed the likely when. But I think there's real risk for this, and I've positioned myself to certainly not be hurt by it in my retirement account, but in my Forex to benefit. Okay. Bitcoin coming down. Is it Bitcoin coming down or is dollar strong? Look at my trend, by the way. Nailed it. Can you believe? And I'm not even joking. I had a half a Bitcoin that I took profit on right there. No. I got it here and I exited here. That's right. There it is. Oh my God. Oh my God. Like, I exited this and then I went and helped my daughter with something. She needed some help. So I went, helped her with that for a bit. And I came back to check out, the market, because I'm like, oh man, I see a little bit of risk in Bitcoin. I got the money in my hand kind of thing. I'm like, yeah. So I cashed out a Bitcoin, went to cash, left, helped my daughter, and I came back to check out to see if it was the right thing. And it had dropped like from here to here. Oh my God. Just like that. I'm like, holy snicker-snacker. I'm so happy I got out. And then, of course, look at that. It's even worse now. So I am so happy I got USD in my pocket. Because by exiting along, what am I doing? Shorting Bitcoin, which I essentially did. Lufle. My money is worth more, and the asset I used to own is worth less. Nice. Good. Felt so good. So now what? That's risk off, Bubba. So I just showed you like the stock market, and part of it is based on this idea that we maintain that sort of momentum. Now, maybe it's too early and it's more like this type of downward momentum, bigger frequency. I call it frequency. But nonetheless, if down is the predominant move, you know, get ready. Asset classes are going to perform differently than they have over the last couple of months. Okay? Which means if that is true, so now if stock market falls, now it's not falling. You see this? It hasn't fallen yet. Not everybody's on the clue train. Not everybody agrees. Okay, but if it falls, if the stock market falls, and if Bitcoin falls, then gold is going to fall. Okay. So we're stuck in a range, okay, for now, but, and that's a big but, okay, I guess you can call it an R1, so S1, we could be on our way to 1950. Or we do this kind of stuff, and we're stuck between 2050 and 20. Okay? So we're here, currently the bottom, 2000, 2050, okay? And that's our current range. But the pivot points are saying, dude, it could actually go down even 50 pips lower than that. So you kind of break it down like this. So up, consolidate, up, consolidate, down, consolidate. Okay? See? And if it does drop down, that's shield up, red alert. Luis is like, just in time, took the money off the table. I'm telling you, it was minutes. And I don't know what that Bitcoin drop was, but dude, it would have cost me thousands of dollars. Like, oh my God. And that's the volatility. Remember, I'm trying to design portfolios or construct portfolios with low volatility and consistent returns. So if you can lose thousands of dollars in an hour on a fairly small trade, yeah. Maybe it wasn't thousands. Would it be thousands? How much does I have of Bitcoin? Yeah, okay. So, no, it wouldn't have been thousands, but hundreds and hundreds and hundreds and hundreds. Yeah. So anyways, yeah, no. Too much volatility. Too much vol, man. You can have that asset. Okay. And I suppose pure luck as well. So that made me feel good. So anyways, imagine what happens if we do this. How does it change? Well, it makes this look like a top and this like a lower low. So now you get sort of this area here of, okay, and now you are trending down. And this sort of thing is happening on things like euro dollar. This is happening on the S&P 500. This is happening on gold. And you're like, maybe there's a relationship between all of these things. Maybe, huh? So looking at this with fresh eyes, doesn't this look similar to gold, where we had a nice little uptrend for a while? Top, 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 lower high, lower low, 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 lower high, lower low. The thing is, when do you get on the clue train? Look, we hit the targets. This is out. Last month was successful. Last month is done, Bubba. It's all over. Targets now are way down here, 106.5. Aggressively. Conservatively, it's really 107.5 is our current target. But we're still at 109. There's 150 pips below us. When do you get on the clue train? What's your plan for next week? Okay, down to 108. Okay, up to 109.5, down to 108. Depends if we do an Arctic turtle down here, maybe, right? But imagine gold is doing this, and the S&P 500 is doing this, and euro dollar is doing this. To me, it's the same thing. I couldn't, right? Like I told you with the astrophysicist at Oxford that were working with me on algorithms. They really didn't even know what asset it was. It didn't even matter. And it's the same thing where, does it matter if Bitcoin's falling, euro dollar's falling, or gold is falling? It's all the same thing. Who cares? Sell them all. Why? It's macro. Okay. Take a look at yen yen. Okay. Cool. I put a support line here last night. By the way, this down, we were talking about this in the swing trading group. That's not a bad trade. That's a failed trade plan, which means it worked. There's no short entry. It's what you would be looking for if you were a bear looking for a reversal pattern. Lower low, lower high, then it would cross back over and you'd drop. We never got a 5-8 cross down. You see that? There's no trigger. That's a successful plan that didn't execute. So anyway, so I drew the support here. So no more down. So we did that last night. That worked out really nice. And now if you're a bear, you probably have this pointed up somewhere. If you're a bull, you probably tried buying it last night on a smaller time frame. And now nobody knows who's going to win. Bears are going to sell here. Bulls have already bought it. And the rest is just risk management. Okay. Well, what about the other assets? Okay. You could see maybe somebody bought it off the monthly central pivot. That's fine. I would say technically, there's still a high probability of continuation down. But if you were a bull, boy, if it did this, it'd be much more interesting next week. So bears are either going to sell it today, or bulls are going to buy it Monday, depending on what actually happens. But I know a bull won't buy it here. Okay? A bat would. Okay, a bear wouldn't buy it there because they're a bear. They're sellers. A bull wouldn't buy it there. Only a bat would buy it. What's a bat? Bulls, I get. Bears, I get. But what's a bat? Nobody remembers? Okay, a bull does this. That's right, Jim. A broke-ass trader. I prefer with dollar signs, right? Okay, we'll take a look at this one. Kiwi, I think I either did today or I did it yesterday. I can't even remember anymore. Taking a look at the longer term. Yep. So just sitting on this now. It's been weeks. Weeks I've been long this. Sitting there, earning my interest. I'm earning money. Every day I get paid some money. Every day at 5 p.m., rollover. Get a few pennies in my pocket. Now we have high interest rates in the United States. And we have low interest rates in Japan. So I'm borrowing yen. It costs me a little bit of money so I can leverage up to buy a huge amount of dollars. And I have to pay for my loan. So I have to pay a little bit here. Meanwhile, I have to pony up some collateral. Not very much collateral. 1%. Okay. So I have a little bit of collateral. I use that collateral to borrow a whole bunch of Japanese yen. I have to pay for the loan, which is hardly anything because the interest rates are low. And then I take all that money I borrowed and I convert it into US dollar. And that investment pays me a much higher yield. So as long as this stays above my little red line there, you can see it's just slightly below break even. As long as it stays above that line, every single day I get paid. Lovely. Huh? Isn't that wonderful? Hey, when's payday? Today! Today's payday. Now, I don't collect on Saturday and Sunday because the banks are closed. But on Wednesday, I get paid my interest for Saturday, Sunday, and Monday. See, it's a, what is it, a T plus 2 or a T plus 1? It's a T plus 1, today plus 1? Yeah, so it's a T plus 1 rollover. So on Wednesday, right? On Wednesday, I get paid for Monday. So I guess it's Tom next, right? Tom next. So on Monday, Monday's collected tomorrow plus the next day. So Monday gets paid on Wednesday because the tomorrow on a Monday is Tuesday, and then the next day after tomorrow is Wednesday. Tom next, tomorrow next. So I get paid Saturday, Sunday, and Monday, because Monday is when you get paid for Saturday and Sunday, but you don't collect Monday till Wednesday. Oh, I know. But I get paid every single day. Cool. Jim says 3-day settlement. Well, it's actually right. Like I said, Tom next. But yes, 3-day settlement's the easier way to say it. But, you know, trading stock, it used to be T3, right? Today plus 3, or then it was T plus 2, then T plus 1, and Tom next. And now clearing is much faster with better technology, of course. Now, Jill says, over the last 4 years, you said over and over and over again, you don't trade USD. I don't. What changed? I took this trade in the middle of a swing trading group. I think I was explaining how to enter a trade properly. So that your observation is correct, Jill. But we were just doing something, and somebody asked me a question, and so it was a few weeks ago. So it might have been something like as simple as this, like we were in this situation. It would have been, right? It would have been a Thursday at that time. So we must have just been sitting right here in a Thursday in a swing trading meeting, and somebody asked me, how do you enter it? Because I get that question a lot, right? How do I enter a trade, Wayne? And I go, click. Oh, just like that. That's how you enter. The entering part of trading is the easiest part. Oh, and then how to do the OCO and stuff. Yeah. So entering a trade is the easiest part. You have to understand that's just tactical. It's the easiest part of trading. So if you already had the strategy of buying a dip at support, and you're like, oh, well, it's already at a higher high. Now we're at a higher low on a role reversal, central pivot point going into a new month, sitting on, an M2. How do you enter that trade? Click. See how easy entering is? But Wayne, do you use a 1 hour chart, a 15-minute chart, a 3-minute chart, a 1-minute chart? Yeah, sure. Whatever, dude. Are you going to pull the trigger or what? I took a whole bunch of friends shooting shotguns. Was it last weekend? Boy, I can't even imagine time. I guess it was last weekend. And it's funny, like, for those that have never shot a shotgun, they want to ask 10,000 questions, right? Well, how do I do this and when do I do that? And should I aim left and should I aim right? And I'm like, dude, are you going to pull the trigger or what? I don't want to pull the trigger. Dude, pull the trigger. But the thing is, do you have a strategy? No, I don't have a strategy. Then don't worry about pulling the trigger. Okay? So anyways, so that's my point. Like, if you're a bull, dude, are you going to pull the trigger or not? Like, what time frame? The hourly, 15-minute, or 1? Dude, the trigger's right there. Just squeeze. Okay? But without strategy, it's all bullshit anyways, right? So anyways, so that's that. Yeah, so it was an OCO, wasn't it? Where did the limit go? Did I kill my limit? No, there's the limit. Look at that. I put the limit up there, 3,000 pips up. So I'm going for 3,000 pips and I have no risk. And while I wait, I get paid every day. So there you go, Jill. And is it likely to collapse on me and I lose nothing? Oh, yeah. Oh, yeah. So we have the forces above and the forces below. And I'm neither here nor there. So this is the kind of stuff you learn at FX Bootcamp, by the way. And I don't go through it quickly. I go through it slowly. The swing trading meetings are 3 to 4 hours. We get detailed. And so this was just like a couple of weeks ago. And for whatever reason, I'm going for 3,000 pips. Okay. Boo-boo. Cool, right? Cool beans. Can I explain OCO? Take the day trading course. There's like a whole lecture. And I give you the OCO tool. So just, it's in the day trading course at FX Bootcamp. Just do that. Just do that. All right. So we stayed away from euro because of the euro dollar. So the US dollar kept us away from a euro yen. And I think we did that one already. So that's still bearish. Some of these are trying to turn bullish. Yeah. But remember, that's not right. You have to understand the likelihood right now, the probability is still this. So it's more like an if-then statement. If equals higher high, then equals higher low. Okay, sure know what I'm talking about? So do we have a higher high? No. So the logic is a bear is going to sell this. And the reason is if you do get a higher high and then you want to buy a higher low, it's because there's no bears. Because they didn't take it down. And you just, dude, that's what a bear would do. Bears would sell this. So if there's no bears, then you have permission to engage. And you would engage here. And you'd put some green on the screen. Ciao. And that's next week's swing trade. Okay. Yeah, that's right, Mark. Yeah, but that's obvious, but it's more like how do you use it and how do you set it up and what's the logic of it, and yeah. So take the course. But yeah, an OCO is an OCO. I mean, hang on, youtube.com. Where does YouTube put this stuff? I never. It's funny. Yeah, anyways, it's not funny. Nothing funny about it at all. Hang on. Must be watch later. Yeah. All right. Here's one. Okay, I'm going to get slapped by YouTube, but, you know, I guess it's worth it.
Is brought to you by DBFX from Deutsche Bank.
The retail foreign exchange market, it's fast, volatile, and highly leveraged. So before placing any trade, you'll need to understand some basic Forex terminology. There are pips, lots, and then there's the spread.
The spread is basically the difference between the buy and sell price.
The spreads are going to vary based on current market volatility. If markets are very quiet and not moving very much, spreads are going to narrow. If the markets are extremely volatile, there's fresh data out, there's major news announcements out, spreads are going to widen a little bit.
The size of the spread helps determine how much an investor profits or loses on the trade.
A spread is determined in pips.
A pip is the last point change in a currency pair.
When we're talking about the foreign currency market, even a change for the US dollar of, let's say, a half a penny doesn't seem like that much, but when you're talking billions and trillions of dollars, it's incredibly important. So we need to then have a smaller unit of measurement.
So in euro, if you're at $1.3605, and it goes to $1.3606. It went up 1 pip.
To turn the pip movement into a profit and loss calculation, all you need to know is the size of your position.
In the FX market, the unit of trade size is called a lot. A standard lot is 100,000 of any currency, and then there are also mini lots of 10,000. So with the 10,000 euro US dollar position, a 20 pip move would mean...
Okay, get ready for it. OCO's coming.
Once you enter a trade, you'll want to monitor whether you're up or down as the market moves. The good news is, online trading platforms will calculate it for you. Thanks for watching. Bloomberg,
Oh, wait. That one doesn't have the OCO. My bad. How do... That one doesn't have it? Wait. Really? Interesting. All right. Well, I guess library. No. There's another one. Hang on. Downloads. No. Library. No. I don't know where YouTube has it. That's terrible. She didn't do OCO, right? Where's the one where I say, when I trade... Oh, here it is, I think. Okay, yeah, it's this one. Hang on. I got to exit this screen. All right, I think it's this one. You guys ready? OCO is explained. Hang on.
DBFX from Deutsche Bank.
Trading currencies, like many investments, can be risky business. The 24-hour-a-day market is highly speculative and extremely volatile, so you'll need to have a trading plan in place before you begin.
There's no 4 o'clock close. I need to realize that price action will continue on beyond in a 24-hour fashion, so let me understand and learn the tools that are there, like orders.
When you put in an order, the way that you manage your risk is by using stop losses and limit orders. You put in a stop order that says if things go bad, if your analysis was wrong and you start to lose money, at a certain point when that stop loss order is triggered, you're taken out of the market before things get worse.
Then there are limit orders that protect you when you're making money on the trade. They are also called take profit orders.
A lot of times what people will do is that they'll see the position move in their favor and then they'll let it completely reverse against them.
McDonald protects his trades using both tools, and when one is triggered, it cancels the other. It's called an OCO order.
When I place an order, I actually place 2 different orders, a stop loss to protect me from the downside and a limit order to where my profit target is.
Another phrase in the language of FX is being stopped out.
Let's say you want to go long, you're buying, the market turns sour on you, you're losing money. You have a stop loss order in place to protect your downside. When that stop loss is hit, you're stopped out.
With a proper risk plan in place, you have a better chance of surviving losing trades and profiting when you make winning ones. Thanks for watching Bloomberg.
To where my profit target is.
Right, so where does it have it? See? OCO. Look at the bootcamp website. Hey, hang on.
It's called an OCO order.
When I place an order, I actually place 2 different orders, a stop loss to protect me from the downside and a limit order to where my profit target is.
So there you go. That's what an OCO is. And I use it all day, every day. And we just covered it last night as well. So there you go. Okay. Oh, look at the scalp. Oh. All right, Daddy's got to go. Time to go to work. Stock market's opening in a few seconds. Oh, look at the scalp. Oh, nice. Oh. Is that Friday? Oh, my God. Anyways, thank you for being in this community. Thank you for your positive contribution to the community. I honestly believe that together we make the world a better place. So thank you for all that you do. I appreciate you. So as we say every day, and I never grow tired of it actually, I think it's important every day. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend.